Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode. Today we have an awesome topic and a special guest on. Today's topic is, what is a cost segregation study and when does it make sense? Now, before we get into that, I just want to remind you that registration is now open on our Small Business Tax Savings Summit, and that's going to be held June 14th and 15th of 2022. And we also have a promotion running that if you sign up before November 30th of 2021, you'll get $150 off. If you're interested in learning more about our Small Business Tax Savings Summit, go to taxsavingspodcast.com/summit. Again, today's topic is, what is a cost segregation study and when does it make sense? And to kind of jump on and discuss that with everyone today, we have special guest Lester Cook with KBKG. Lester, welcome to the show.
Thank you.
So this is a strategy or tax strategy that we talk a lot about, and really kind of this stems around having real estate or some type of real estate within your entity, whether that's a rental property or it's a building that you might own as a business. So I just want to start out by kind of starting this question, Lester, by saying, what is a cost segregation study? What is cost segregation?
Great. That's a great place to start. So cost segregation is really it's a strategic tax planning tool that companies and individuals use that have either purchased, expanded, constructed, or remodeled any kind of real estate that they use to increase their cash flow, and it accelerates deductions, thus by deferring federal tax and in some cases state income taxes.
Awesome. So, when would a cost segregation study make sense? What type of business owner or what type of rental property owner, when would they start to say, yeah, cost segregation is something that I may want to look into and see if it's something that's made for me?
Yeah, so a couple of different criteria. First thing is the property needs to be income producing. So we do get a lot of questions from folks that may have Airbnbs or things like that, and or maybe even own their primary residence, asking about a cost seg. And first and foremost, it needs to be income producing. And additionally, you need to have a tax liability. We could do all kinds of accelerations, but if you don't have tax liabilities, then it doesn't really help you. As far as timing, anytime you acquire a new piece of real estate is a great time for a cost seg study. Anytime you construct a new piece of property, it's a great time for the cost segregation study. Fortunately, there's a mechanism that allows you to go back and take advantage of a cost segregation study, even if you hadn't done this in the past. Maybe you're listening to this today and you're just learning about it for the first time. And say, geez, 5 years ago, I would have known that this existed. I would have done it then. Well, we can still do that with an accounting method change. So really, the short answer is anytime is a good time. But ideally, it's as soon as you acquire or you construct a piece of property or remodel a piece of property is a good time.
Now, as far as going back, let's say we do have someone that's on and they maybe constructed a new piece of real estate a while back. Is there a certain time period on when they can go back and adjust that, or is it pretty much unlimited?
Yeah, I mean, it's unlimited for all intents and purposes, right? You can go back to 1987. Tax Reform Act of 1986 is where this all kind of genesis from. Reality is you're not going to have depreciable basis. So generally what we say is, 2000 is probably as far back as you're going to go, because, at year 2000, it's 20 years ago in 39-year life property is halfway depreciated. There might not be much left on the bone to kind of accelerate. But again, all intents and purposes, we can go back to, the beginning of time, which is basically 1987.
Okay. Now, when we're building a piece of property or something like that, is there a certain dollar amount where, yes, it makes sense? Or if we're putting a $100,000 shed onto our business property, does that make sense to do something like that? So is there a dollar threshold where it starts to be beneficial versus not?
Yeah. Again, yes and no. It all depends on the circumstances, right? So Generally speaking, we would say $1 million of new construction activity in a commercial space is what we need to see for a cost seg study to make sense, between paying for the fees to complete a study and the acceleration and the timings and things like that. With 100% bonus depreciation, we've seen that number go down to maybe $750,000 is where it would make sense. From an acquisition standpoint, we've got mechanisms where we can help with taxpayers that own residential properties that are as low as $100,000 in cost basis, and maybe even $50,000 in cost basis. So the reality is there's not truly a limit. We have solutions that can kind of fit every scenario.
Okay. Now, when we're talking about a cost segregation study, just kind of go through the process. What's typically involved in the study? What does the process of a cost segregation generally look like?
Yeah, no, happy to. So there's really two different types of cost seg studies, just like there's two types of real estate transactions, right? There's a newly constructed and there's an acquired. In a newly constructed cost segregation study or a newly constructed opportunity, the first thing that we start with is a general ledger download of all of the CWIP, all of the costs that were incurred related to the project. And then we analyze that. Our team is filled with construction engineers, architects, civil, mechanical engineers, construction managers. We've all got, numerous years of experience going through cost records. So we review all of these cost records and we componentize them based on, the description, the contracts, general things like that. And then from there is where we apply the engineering-based principles and further componentize. So, for example, if your contractor gives you a schedule of values is what it's referred to, and maybe there's only 10 lines of data on there that says, concrete, electrical, plumbing, and totals to $3 million. And all that we know in there is you spent $250,000 on plumbing. Well, we ask for a set of blueprints for the property and essentially reverse engineer the building, working backwards to that dollar amount of the plumbing number, and componentize the different aspects of plumbing that may be depreciated over a 5-year period, a 7-year period, a 15-year period, and then the traditional 39-year life period. So, it's a labor-intensive process on our end of analyzing the blueprints. But from a taxpayer's perspective, it's relatively hands-off. You kind of provide us the information and we take and run with it from there. For an acquired property, those are a similar path. Obviously we don't have construction cost information. So at that point, you say, well, all we know is the building costs $2 million. So we go in and we reverse engineer the entire building, based on some, utilizing some IRS approved costing materials. But we then develop a cost basis for every single component of the property. And then from there, every single, short life, long life component of those components. So where there's some inherent value from an acquisition standpoint is not only are we going to bifurcate the 5-year life property that you can accelerate, but we're also going to bifurcate things like the roof or the windows or the doors where, in the future, I'm going to put a new roof on. So I want to take a disposition and those bases are there. So really that's what the processes are. It's just kind of doing a reverse engineer approach of the building.
Got it. And when we talk about doing a cost segregation study, what are the benefits that we're looking for? Why is someone saying, yeah, I want to explore a cost segregation?
Yeah. So again, this is all a cash flow benefit. We're reducing, accelerating deductions. We're not creating any more deductions. It's not a credit. We're just accelerating deductions that you would have taken over the next 39 years or 27 and a half years in terms of residential into a faster period, thus creating that cash flow. So, looking at it from the perspective, if you've got a residential rental property, for every $1,000 of basis of that residential property that we could move from 27 and a half year life property to 5-year life property with 100% bonus right now, the present value of that is about $238. So, and from a commercial perspective, every $1,000 that we move over is about $277. So, and that number is based on a blended tax rate is, roughly 40% tax rate and an 8% present value factor. But generally, that's what we end up seeing is, every $1,000 we move over is $250 to $300 of net present value in those deductions.
Got it. So the idea behind it is traditionally we do a renovation or we reconstruct a building. We have to traditionally that depreciation would run, a fairly long time where we get to depreciate that property, but it's going to be the course over many years. And the idea behind a cost segregation study is, okay, let's look at the details of that specific project a little bit deeper and see if there's things that we can pull out of there that we can take from a longer depreciation schedule to a 5-year or a 7-year, or even a bonus depreciation where we're getting it all in the same year. So we're taking that depreciation that we're going to get eventually, but we're just moving it up into being available for us today versus 20 years down the road.
Precisely.
Got it. Now, is there any kind of properties, I know we talked about, rental properties and residential. What type of properties is this going to be available for? Is this putting up a new building that, we're constructing a new building for a factory that we're putting up? Is this building a new rental property? What is kind of allowed, or where cost segregation would make sense? And what would be kind of an example of maybe a type of property or building that cost segregation would not qualify for?
Yeah. So, the great answer is this technique and this strategy can be used on all types of properties. Again, as long as they're income producing properties and there's a cost basis there's an opportunity. Where we see the most interest in having a cost segregation study performed is in residential rental properties. Apartments, whether they be small 4 flats in the city or some massive track 300 unit apartment buildings that are built out in suburbs or what have you. That's where we see the majority of interest, but also from things like strip centers, office parks, individual office buildings, just about anything, factories, warehouses. In terms of best bang for your buck, reclassification rates on apartments are relatively high, in that probably 15 to 25 and even more percentage of the total cost being able to accelerate, the deduction time frame on. And currently 100% bonus. So, 25% of the total cost you're spending, you get to write off immediately in the first year. Things like office buildings, maybe those are in that 15 to 20, 12 to 20% range, things like that. Warehouses are going to be a little bit less because there's just not as much in a warehouse. But again, if you're talking a mega distribution center that's got, parking for hundreds of trucks and things like that, and all of that is short life property that's bonus eligible too. So, tons of options for everybody, really.
Yeah, makes complete sense. And so, as we're kind of looking at who's an ideal fit for this, it's basically somebody that has new construction, maybe older construction that we want to reclassify. But the key thing is having that taxable income, because accelerating a depreciation or getting more depreciation today versus tomorrow only helps us if we have income that can offset. So that's kind of the key factor that comes into play there.
Exactly. And the nice thing with the deductions too is that they're not limited. Like I say, they are limited somewhat in a carry forward capacity from the NOL rules perspective. But, as far as, if I'm accelerating $100,000 of deductions this year and I can only use $50,000, I don't lose that other $50,000. It still carries forward. But, it may not make a ton of sense, to have a cost seg study done if you're accelerating just, if you can only use a fraction of the acceleration that you're looking at. Another key thing that you have to look at is passive activities, right? So, and again, we do get some questions from taxpayers that call us and say, hey, I bought this rental property. Can I get a cost seg study done on it? And say, yeah, absolutely. Well, also, by the way, I'm a doctor, and that's how I spend my primary, my primary income comes in. So, again, we can accelerate $100,000 of deductions maybe this year, but if it's passive activity and the only income you're having coming in is from that passive investment in that, that one apartment building, maybe we're creating $100,000 of deductions for $20,000 in income. Doesn't make a ton of sense. So that's the biggest factor to think about, as you're contemplating whether to have a cost seg study done or not.
Makes sense. And when you kind of mentioned like cost and things like that, and I'm sure every cost seg is a different cost and kind of where we're looking at that. But, generally talking, let's just use an example of some benefit of accelerated depreciation that we're getting. Kind of what do some of the costs, just as an example, look like for the study?
Yeah. So, a typical engineering-based study that we would perform, they're always based on the amount of time and effort that we would take to complete the project. So, saying that, that mega apartment complex with 30 buildings in the suburbs, that's going to cost more to have a study completed than, the Ford flat in downtown Chicago. That being said, there's still, some basis to it. So, typically a cost seg study ranges between $5,000 to say $15,000. Again, there could be some that are $100,000 if you're talking about a massive development or $300 million casino or something like that. But generally speaking, it's at $5,000 to $15,000 range. And then for the smaller properties that I mentioned, those $50,000, $100,000 single family houses or something like that, we do have a solution on our website that's, it gives it an opportunity for a $400 kind of do-it-yourself, high-level cost seg study called our RCS.
Awesome. Well, this has been, super helpful, and I think it provides a lot of insight for those that this might qualify for. And for everybody listening, we're going to have a website that's in the show notes that you can go to, learn a little bit more about kind of what we talked about today, as well as get a time to set up a call with Lester or someone on Lester's team to kind of discuss, would this make sense for you? And if it does, go ahead and move forward with kind of doing that with Lester and his team at KBKG. So, Lester, I just want to thank you for coming on and sharing these insights. This, again, is a great tax strategy and way to accelerate that depreciation, get some expenses today that typically would not come years from now, as long as it's a good fit for whoever may be looking for it. So I appreciate you taking the time today. And like I said, everybody, we will have a link in the show notes to take you to a website specific to cost segregation where you can dive deeper and set up a call with Lester and his team. We also, on our tax minimization program, had a webinar that we did with KBKG that will have additional details on there. For those of you that are members of our tax minimization program, feel free to check out our cost seg area on there. And then for those of you not members, you can check it out at taxsavingspodcast.com/tax. So, Lester, I just want to thank you for jumping on and I appreciate you taking the time today.
Oh, thank you for having me, Mike. More than happy to be here and happy to spread the cost seg gospel to everybody.
Awesome. Well, thank you, listeners, for joining another episode, and I'll see you guys next week.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.